Welcome, welcome, welcome. You're listening to Destination Retirement. My name is Robert Kuhn. I am the president and founder of Kuhn Capital Partners. I'm independent. Our firm is independent. We are fiduciaries. We do focus on financial planning. We do focus on income maximization, tax reduction. Most importantly, we focus on trying to incorporate strategies that can deliver positive returns in negative markets. Yes, that is different. Yes, that is a different story than many of the other investment radio shows that you listen to on this station, but it's a story that is very appealing. And here's what we are selling. We are selling education. We want investors not to lose money for some of their money, even when the markets go down. And you can do that outside of an annuity. Imagine that, outside of an annuity. If you have any questions, if you've listened for a long time and you want to finally reach out, great. Give us a call. You can call Paige, 630-492-1912, 630-492-1912. Set that initial consultation up, set that call up, and we can really just learn more about what you're doing and see if we can add value to your situation, answer any questions that you do have. Obviously, the markets, the valuations they're very stretched. Markets are high, yet we are cutting interest rates. Think about that. All-time highs, yet we're cutting interest rates. So the question is, what happens next? And that is what we're getting a lot from. So the listeners that reach out, it's picked up in numbers, which is obviously great. It means our message is resonating with individuals. It's always strong, but you guys are making me work a lot more than I'm used to. But I do love it because, we believe in education, and as we are on the radio is as we are in person. So I tell everybody that we talk with, it's not our agenda, it's your agenda. And I think that resonates with people because they realize that we have a service. We have a unique service. We have strategies that the typical advisory firm doesn't utilize. And I bet you everybody on the radio is going to say the same exact thing. It's, when we're in meetings, and I think it's so fun to kind of peel back the curtain on our business and what it is that we do, what it is that advisors do. And I'm probably going to start to do more about that, or more kind of talking about that, because it's a very unique business. It's a very fun business. It's a very challenging business. It's a business sometimes that has you scratching your head, because we meet with people of all types. And I feel more like a psychologist in many instances than a financial advisor. Money manager, call us what you want. But I love that because I love the opportunity to help. I love the opportunity to improve individuals' situations. And that's what we do, and those are the individuals that we love to work with. So, as you know, or maybe you don't know, if you are a new listener, our strategies that we bring to the table are unique. They're different. Again, that's not every advisor is going to tell you that, but we're going to actually show you it, and I think it becomes very clear very quickly that we have these strategies in place, and we're going to talk about the most recent banknote here in 1 minute. So we love the banknotes. I think we talk a lot about that, but I always want to preface any investment, and I generally always try to make sure that we talk about the good of an investment, the bad of an investment, because there's always a good and bad, or there's a perceived good and there's a perceived bad, right? But everything we talk about on the radio is for education. 100% education. And if you call in, we dive into, these strategies in much greater detail. And that goes with the banknotes. I mean, the banknotes are, in our opinion, the income banknotes are phenomenal. And obviously it resonates to listeners because, what I tell individuals, because we meet with a lot of people who are meeting with other advisors, right? They're looking at, hey, you're one of two or three that we're interviewing. And I say that's fantastic, because I think it's, at least in our belief, that we will very quickly rise to the top when it comes to strategies, because we're not the same. We're not, run-of-the-mill advisory firm. We're not going to just pitch annuities like everybody on this radio, the radio shows, not just here in Chicago, but everywhere. That's all they do. And I'd say, 80, 90%, it's tied up into an annuity somehow, some form, some way. And that's not to say annuities are bad, right? Because again, we use a 5-year annuity where, I have an issue with annuities in a lot of instances is the lifetime income, because people aren't explaining what lifetime income really means. I mean, sure, does lifetime income sound great? Of course, my goodness. Who wouldn't want to hear guaranteed lifetime income? No, I mean, everybody would, right? I mean, that's probably one of the greatest sleep at night factors or strategies or, words that you're going to hear, especially for that $500,000 to kind of $5 million client. I mean, they love, to hear that. But the challenge is, on the lifetime income annuities, is you're only taking your own money out until that account goes to zero. And you have to hear me on that. You are only taking your own money out of that account until it goes to zero. And you have to think that, well, the insurance companies probably know actuarially, statistically, that the bulk of those accounts is not going to zero. Because when the account does go to zero, then you're in the insurance company's pockets, right? The insurance company's actually writing you a check from their own money, let's say. So the insurance companies, it's my belief, excuse me, that they hedge that risk, of course, by giving you just enough growth so the account never goes to zero, and then limiting the distribution amount, limiting how much you can take from that account. So what are you paying for? It's almost in many ways, it's almost, in my opinion, a way to guarantee that you're always going to have less, because limit the growth, let you take out money, well, your account is really just going to continue to go down. And what I don't think most individuals think about is, how does inflation affect that withdrawal amount 5 years from now, 7 years from now, 10 years from now, 15 years from now? So if you're taking out 5% of a declining asset, because they are going to decline, I don't care what the illustrations say. And if you're being sold an illustration that shows anything more than 4%, 5% historical growth, it's back tested, not actual performance. I mean, that's just the truth. So what happens when you're taking out a fixed rate today and then inflation hits 10 years from now? Well, inflation compounds, right? But 10 years from now, what does that do to your purchasing power? Because when you talk to people with pensions and obviously Social Security, the biggest complaint that you find is, well, it's not keeping up with inflation. I mean, I guess Social Security gives you a cost of living wage, but is that really keeping up with inflation? So anyways, kind of, went down a rabbit hole there. But there are ways to get better income. There are ways to get more income. There are ways to, give you that guarantee. And again, we talk about the banknotes, and our strategy of managing money is really fourfold, right? It's protected growth, it's growth plus, and then it's alternative tax reduction. That's unique. Every advisor is going to do the middle two, growth plus and growth and fixed income. I mean, that's easy. Every advisor is going to do that. And they're going to tell you that, well, don't worry about losing money, because the markets go up over time. And nobody is questioning that. Nobody is questioning that the markets historically have gone up over time, right? But the markets can stay flat to down sideways for a lot longer than you may think. Again, you bought Microsoft in 2000. It took you around 12 years to get back to even. So think about that, right? So when we look at protected growth, and I see far too many people buying these lifetime income annuities, and I see advisors, and I know the advisors on the show. I mean, I see that, in many instances in the annuity space, we all work through, or we know people who work through the same, channels. And so we know, and we have a very good idea of what and how much they're doing. And it would amaze you, absolutely amaze you, that to every advisor, well, I don't want to say that, but in a lot of instances, a client calls in, they already know what the answer is. They already know what the solution is. They already know what they're going to pitch you. They're going to pitch you something that pays a high commission and annuity that gives you that lifetime income, but yet they're not going to educate you on the pitfalls of the lifetime income. We will. We absolutely will. And then if you still decide that you need that peace of mind to sleep at night, then okay, great. but you went in eyes wide open. And so we get pigeonholed a lot as the advisory firm that doesn't like annuities. No, not true at all, because we have a 5-year annuity that we use. We consider it a growth annuity that we absolutely love. And so many people love it. It's short term. It's directly tied to the S&P 500. Your worst year is 0. So if the S&P is down 1 or 50 or 100, it doesn't matter. Your return's 0. And for that trade-off of not being able to lose money, currently your growth is capped at 9% a year. So it looks at the S&P price movement, because they don't include dividends. So it looks at the S&P, and you get the first 9% of the S&P, not including dividends. And when you get that gain's locked in. And who am I to say that that's not something that appeals to many, many, many people in their 50s, 60s, 70s, 80s, because they want that peace of mind. And this is an investment that you're not tying your money. Now, you could own it forever, right? It's just a 5-year commitment, because that's how the annuities work. There's, penalties if you take out more than X percentage, and this one happens to be 10% a year. So you do have liquidity, but anything more than 10%, you pay what's called a surrender charge. After 5 years, there is no surrender charge. But you think about that. How many people should be in that versus the lifetime income story? Because we can get income, in my opinion, double what these annuities are going to give you. But if you really need that peace of mind, I suggest that you look more towards that shorter term annuity, the 5-year annuity, that gives you 100% peace of mind that you can't lose, right? Based upon the credit, wherewithal of the company, of course. And then the growth is tied to the S&P, and you get the first 9%. And if that's something that appeals to you for some money, then great. Again, we want to talk about it. Where does it fit in your overall portfolio? But because we love the banknotes. But 630-492-1912, 630-492-1912. If you have an interest in learning more, because when we look at protected growth, so that 5-year annuity, it's really a structured note, which may not mean anything to you, offered by an insurance company, but it is an index annuity. I mean, that is the legal title of it, but it's no fees, but it is a great strategy if you really need kind of that peace of mind. We love the banknotes. People who listen to the radio show love the banknotes because they call in for the banknotes. And when I tell you that people tell me not to talk about the banknotes on the radio, they do. You look at people who do radio shows and consult with people who host radio shows. They say, no, keep it much more vague, keep it much more basic, keep it much more high level. You want them to call in. I'm like, I don't care. If they don't want to call in, that's fine. Then they can take this information to their advisor and do it. Now, 99 or 95% of advisors don't do banknotes. I mean, they just don't do, structured notes and income notes and other notes, just because the minimums, when they first became accessible to individuals, which was really, I think, the early 2000s, at least where I was at the time, you needed a minimum of $1 million net worth to even do a note. And in many instances, you had to, have significant amounts of money to do a note. And today, they come in increments of $1,000. Think about that, $1,000. So we did an income note this week that was backed by Morgan Stanley. So it was a Morgan Stanley, I call them an income note. There is a legal name. It's very, very long. It is a senior unsecured debt of the firm, just like very similar to a corporate bond, but it's tied to the equity markets. And so this one paid 12.3%. So we did it at Price Tuesday, 12.3%. As long as the indexes that the note was tracking were not down 30%, you got your monthly coupon. So it was whatever 12.3 divided by 12 is 1.04 or something like that, 1.03. That's really strong. So think about that. Think of it as a way, okay, well, I have, 30% downside protection to still make money. So if that's something you want to learn about, let's chat. 630-492-1912, 630-492-1912. We'll talk about the Fed and interest rate cuts after the break. Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president, founder of Kuhn Capital Partners. We're headquartered in Naperville, Illinois. If you can hear my voice, we can work with you. We do run the show in multiple markets. We're trying to increase our footprint as much as we can. So if you are hearing the radio show, understand that we can work with you, and we want to work with you if you are open to incorporating strategies that can deliver positive returns in negative markets. If that's you and you want to have an initial conversation, give us a call, 630-492-1912, 630-492-1912. Paige will set up a time that works for you and works for us. Generally, those calls are 10 minutes, 15 minutes, 20 minutes. Just learn a little bit about what piqued your interest, what you like that we are talking about, or if you are new to our show and you haven't heard the show in the past, but something I said piqued your interest, then we can dive into what it is that we do as a fiduciary, as financial planners, as income maximization strategies, as tax reduction strategies. That probably grammatically doesn't sound very right, but we're good at numbers. How about that? 630-492-1912. So the banknotes, obviously, we were talking about the banknotes a lot, last segment, and they're very, very, very popular. You want to work with somebody who does them in volume. Like we do. I don't know where we rank in the Chicago market, but I would imagine it's certainly within maybe the top 10. I'm not sure. But if you look at, who for advisors who advise retail individual investors, and what we classify as kind of retail is, the investor who has, $100,000 to, kind of that, $7 to $10 million range. I would imagine that we're towards the top. And why do you want to work with somebody who does it in volume? It's really simple. We get better rates. And when you commit to more volume, the banks are going to give you better rates. So we can get, 1%, 2% better rates than somebody who doesn't do it at scale. Well, we consider it to be scale. So that's why, you want to work with, somebody like us that is going to do the banknote. So yeah, last week's was Morgan Stanley, 12.3% annual. That was a coupon. And it was tied to 3 indexes. And as long as those indexes from 924, so it priced on 924. So all they do is lock in the closing indexes that the note was tracking. As long as those indexes each month, they get checked. So October 24th, or if it's a weekend, it's a day before or day after. As long as those indexes are not down 30%, you get your 1.04% coupon payment. So think about that. Markets could be down 20% and you're still getting paid. Making money, compounding money, even in down markets. Isn't that the job of an advisor? Bring you strategies that can do that. So I talked a little bit in the first segment how when we meet with potentially new clients that they are interviewing other advisors. And we love that. We welcome that. We don't care if you meet with 100 other advisors, because 98% of what we say, us and them, are going to be very similar. Maybe we have a little different spin. Maybe we present better. Maybe we are better talkers. Maybe we're better educators. Maybe they're better than us, whatever. 98% of what you hear when you talk to somebody like us is going to be very, very similar. It's the 2% difference that is going to make the greatest impact in your ability to compound your money and to grow your money with the least amount of risk, the least amount of volatility, ultimately the least amount of stress. That is what we are trying to do. And what I suggest most people do is when you're meeting with an advisor, whether you're currently working with one or you're interviewing one, the question you ask is, show me what percentage of my portfolio can make money if the markets are down. It might be down to a certain point, like the banknotes we do. Generally, we do 30% downside protection. So as long as the indexes, the notes tracking are not down 30%, you're getting paid. I mean, that's it. If in a month that it is down more than 30, well, then you miss a coupon payment that month. But okay, fine. So what? So that is what we want to ask. We want you to ask your current advisor, show me what part of my portfolio would make money if the markets were down. If they can't do that, then mentally end the meeting. be respectful, probably stay there, hear them out, right? But mentally, you want to end that meeting because that advisor is checked off the box. We're not working with them. At least that's our opinion. Because when you have 10%, when you have 30%, when you have 50% of your portfolio that can still deliver positive returns, it's predefined. We know the rules of the road. We know the answers. We know how we're going to make money before we invest. Isn't that what everybody wants? I would think so, right? But here's what most advisors are going to do. When you ask them, they're probably going to say no. They may even say those investments don't exist, which is even worse, right? They may not exist in their world, but bank notes, structured notes from the big banks, again, JP Morgan, Citi, Bank of America, UBS, et cetera, Morgan Stanley, that's a couple $100 billion a year market if I had to guess. And it just might be a market that they've never played in because they've never done them, right? So if you have 30 to 40 to 50% of your money in an investment, whatever that number is, right? A chunk, let's just call it that, a sleeve, an allocation, call it what you want. But that is still going to deliver positive returns in negative markets. If that advisor does not have that, why are you working with them? Why would you continue to interview them? Because when you ask advisors, most are going to say no, we don't have it. They're going to immediately flip the conversation to, well, the markets are going to come up, back, the markets are going to go down, the markets are going to come back, but long term, they've done X. Of course, we're not debating the fact that markets go up over 100 years. Nobody is debating that. Heck, I don't think the markets have never grown over a 20-year period, may even be 15-year period. So nobody's debating that. But the markets can go down. They can go down and stay down. And if there's strategies out there that you can utilize to make money when the markets are down and your advisor's not incorporating them, why? Why? It's just not good enough. Not in today's day and age when the minimum investment in a banknote is $1,000. $1,000. So don't tell me, Mr. and Mrs. Advisor, that you're the most cutting edge, that if your only risk management strategy is diversification. Well, let's break that down. What does diversification mean? So if you look at your statement, or if you go with, to meet with a new advisor, you're working with your current advisor and you own 50 mutual funds, 50 stocks, whatever, I don't know, 50 ETFs, and you think you're diversified. Well, you're not. You're diversified in an equity market. You're diversified if the markets go up, you're good. Well, what does that mean? That means you're not diversified in any way, shape, or form. You're diversified in an equity market or an equity strategy and a fixed income strategy. So that means you're on the Wall Street roller coaster. That means that you're going to make money when the market's up. You're going to lose money when the markets are down. And there's a huge money manager out there. I'm not going to tell you who they are because I don't want to get a letter from their attorneys. But everybody knows they hate annuities. So that's all they talk about. Hate annuities. Hate. They have the best marketing that I've ever seen in this industry. Ever. And they're all over the place. And if you have $500,000, you meet their criteria, right? Why don't you ask them about their performance? I met with a new investor this week who they managed, a bunch of money for this, this investor. And once he told me who it was, I said, okay, good, great. He's like, I met with our investment committee, all individual stocks, which is what I like. I'm like, great, that's their pitch, that's their marketing. I'm going to tell you before you tell me that they've underperformed the market and they have no downside management other than the market's going up. And he's like, absolutely. And he's been there 2 years. And it's really great that people are starting to recognize that. You're paying an advisor that is underperforming the market. As good as their marketing is, as great as and sophisticated as they sound, and as many billions as they manage, you're still underperforming the market. So what you're doing is you can get that, I think they own 90 stocks. So you could just go and buy the S&P 500 at Charles Schwab and go buy the AGG, which is, a bond proxy, and you're going to do better. You're going to do better historically. And this isn't up for discussion. It just is what it is because numbers, I guess numbers can lie. Numbers can tell many different stories, just like statistics. But if you look at raw performance, which I do want to caveat, I don't think you invest with a manager simply because of raw performance. There's so much more that goes into it. But so much of the marketing out there is to make an advisory firm seem different, but they're all the same. They are all the same. A little different pitch, a little better said, but at the end of the day, they track the market up, they track the market down. And that's not good enough. That is not good enough in this market. We've got an election coming up. We have all-time market highs and valuations, which is great. Debt is through the roof. Credit card delinquencies, obviously off the charts. Card delinquencies off the charts. You know, the market is so thinly traded in that you have just a handful of stocks that are still, moving the market up. Wouldn't it be great to have a strategy in place like that 5-year annuity that you're not committing to it forever? It's 5 years. Okay, fine. But 5 years is a very important time period if you're in your late 50s, in your 60s or 70s, obviously, just, because you don't have, time isn't your friend. And think about this also, go down, one other rabbit hole before I get back to what I was talking about. If you're drawing money out of your portfolio and the markets are down, those losses are magnified in a way that I don't think individuals know. So yes, the markets are down 20%. The math tells us the next 25% of gains that you get is just going to get you back to even. Think about that. You lose 20%. Well, big deal. You're down 20%. Well, big deal. Advisors are the only ones that say don't get emotional about losses because it's not their money. They're managing other people's money, which is crazy, right? But the next 25% of your money is going to get you back to even. Now, if it's a specific strategy that is very aggressive, that is known to be aggressive, that is a strategy that's going to go up a lot and down a lot, okay, fine. I mean, we get it. But we're talking about basic portfolio money management. We're talking about your core portfolio money, okay? If you're taking money out of that portfolio, think about that. I didn't do the math. I haven't seen I can. I mentally, I think, or if I do it quick, just kind of back of the napkin without a whole lot of thought, I think maybe you're at 28% just to get back to even, or maybe even 30% if you're pulling out 5, whatever that number is. When you start to take money out of your investments, which a lot of people do, some don't, but a lot of people do, and the markets are down, that is so different when you're continuously putting money in when the markets are down. Because yes, if you're putting money in when the markets are down, you're buying the dips, whatever, I get it. But if you're pulling money out and you're not working anymore, or you're near retirement, those losses are magnified in a way that Wall Street has failed you to tell you just how substantial they can be. And that's why you have companies like Calamos Investments. I love Calamos. Calamos, innovative off the charts. They don't own us. We don't own them. There's no affiliation. I'm not promoting them. They're not promoting me. Those are all the disclaimers. But they recognize it. They have some phenomenally innovative strategies that they're coming out with. And it all is about downside protection. So you can do it on your own, no doubt. You can go, but I think in this world, in this day and age, with the complexity of these products, they're really basic to me, but they're probably, can be overwhelming to you. And it's not because you're not smart. It's not because you can't learn them. It's just we have a 25-year head start on you. And so we stand in front of our clients and let all of the Wall Street products come at us. And we hold the shield. We do the vetting. And if it gets through us, then we talk about it with our clients. So 630-492-1912. 630-492-1912. If you have an interest, give Paige a call. Let's have a conversation. Welcome back. You're listening to Destination Retirement. Thank you. Hopefully everybody's having a great day this Saturday. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent registered investment advisory firm. Yes, we are fiduciary. Yes, we believe in financial planning. Yes, we believe in tax reduction. Yes, we believe in income maximization. But that's not why you work with an advisory firm, in my opinion. In my opinion, you work with an advisory firm because they are using the most cutting-edge strategies that can deliver positive returns in negative markets to a point. Yes, I say it all the time on the radio, but that's it. And we planted our flag, and that's what we're doing. And we are bringing the strategies that others aren't to you. Not because they can't, it's just they won't. because it's very labor intensive. You look at the bank notes, right? The Morgan Stanley note we did last week, 12.3% annual, as long as the indexes it tracks weren't down 30%. So yes, it can be down 29.99%. You're still making, in this instance, it was a little over 1% a month. That is something that you really need to hear about. But yes, we do believe in financial planning. Yes, we do believe in income planning. Yes, we do believe in tax reduction, which we'll talk about here in a minute. And don't let me forget that. Well, you can't because it's a radio show, but mentally I'm not going to let you. I'm going to make sure you remind me to talk about tax reduction. But we don't want to, wow you with our financial planning. It is good. It is great. It's as good as anybody's. I mean, there's just 3 or 4 providers that all run basically the same report, and we stamp our logo on it. So it's financial planning isn't anything greatly unique, but I see far too many people talking and working with advisors simply because of a plan. The plan's not worth the paper it's written on if you lose money. What you need to do is we need to turn the conversation to performance. It's something advisors don't like to talk about because it's something that the average advisor, and I would say the bulk of advisors, simply have strategies that are going to track the market. And if you're paying a fee, you're inherently already going to underperform that market because the bulk of advisors are using index-based strategies that track an index. Well, if that strategy tracks an index and you layer on an advisory fee, well, you're just guaranteeing yourself you're not going to keep up with the market. So what value are they bringing to the table? If you want to talk with an advisor and have them hold your hand and reaffirm you in down markets that everything's going to be okay, you can go to Vanguard and do that. You can go to Charles Schwab and do that. You can go to Fidelity and do that. There's plenty of firms out there that have very capable advisors. Now, I don't agree with those strategies, but who am I to tell you what to do with your money? But if that's how you want your money managed, that you want it tracked up and down, you don't care. You believe that over time the markets go up. Well, we're not debating that. I just hope we're not in another sideways market like we were in the early 2000s. And you just see how stressful that can be when you're not working anymore or retirement is on the horizon. But if that is what you want, if that is how you want to manage your money, it's your money. Who am I to tell you what to do with your money? I have to ask you a question, though. Why are you working with an advisory firm that you're paying 0.5%, 1%, 1.5%, or 2%? That adds up over time. Newsflash, you can meet with an advisor. Now, I don't think the caliber of advisor is as strong as, say, we are, but an advisor at Charles Schwab, at Fidelity, at Vanguard. You can do that. You can do it on the phone. You can do that remotely. You can go in and see them. And don't pay an advisory fee. Now, again, I'll put that strategy up against our strategy. And when you can incorporate strategies that can deliver positive returns in negative markets, well, the math is generally on our side. So if you're looking to compound your money, which who doesn't want to, I think we're going to compound that money at a significantly greater rate, and we're going to do it with significantly less risk and volatility. But if you don't want that, don't pay an advisor. So let's talk about tax reduction. When we look at tax reduction, you look at tax strategies. If you're working with a big bank, if you're working with a big brokerage firm, they do not have the most proactive tax strategies available to their individual clients. They don't. They just don't. Don't believe me? You do your own research, you're going to find the answer. I'm giving you the answer ahead of time. Tax planning, tax reduction is the most overlooked area of financial planning. I know this because we have a tax advantage strategy. It's called the KCP Energy Fund. Now, you need a minimum net worth of $1 million, not including your primary residence, or you have to hit certain income requirements, which just look up accredited investors. I think it's 300,000 single, maybe 400 joint, I'm not sure. But look at accredited investors. So the KCP Energy Fund is a strategy that we use for those investors that meet that criteria, and that it's appropriate for, of course, right? But when it comes to tax reduction, the energy space has in my opinion, the greatest tax strategies, tax reduction strategies known to man and woman. For those real estate investors that invest simply because they want that passive income, well, you're really going to love this. So strategies, again, I'm telling you the highlights. All right. I am not telling you that there's not risks. I am not telling you that you don't need to review the documents, that you don't need to speak with an accountant, because I'm not a tax professional. I cannot give tax advice. Now, I know what the tax benefits are, but it's always best practice to read every document you can, do all of your independent research, make sure you talk with tax professionals, whoever does your taxes. I mean, that's very, very important. I want to make sure that we're giving you all of the qualifiers. But had you invested $100,000 last year, you reduced your active or passive 1099, W-2, capital gains income by almost $90,000. Think about that. For every $100,000 invested, you reduced your taxable income, active, passive, W-2, 1099, etc., by almost $90,000 in an investment that is investing directly alongside, or in funds that invest directly alongside, of the major oil and gas companies, Exxon, Chevron, Matador, all of them, the majors, right? There's a huge market out there for these investments now that individuals they're generally still not accessible to individuals. We look for deals that are too big for individuals generally to write a check, and too small for institutions to pay a lot of attention to. So kind of that $1 to $10 million space, where we're investing, again, directly alongside of the majors, or in funds that invest directly alongside of the majors, Conoco, Exxon, all of them. And this investment has targeted distributions of double digits. It could be, we like to say 10 to 15% at, $60 oil. That's just a base case. Could be more, could be less, of course. But when you can get an investment that has significant tax benefits. So if you're a high wage earner, well, this is great for you. If you sold a business, this is phenomenal for you. If you sold a piece of property that you have significant capital gains, this is great for you. If you want to convert money from an IRA to a Roth, well, this is phenomenal for you also, if we're just looking at taxes. Now we have to talk about what the investment is, of course, no doubt about it. But think about that. For every $100,000, you reduce your taxable income by almost $90,000. Go try to find that at a big brokerage firm or a big bank. It's not happening. It is just not happening. Now, they may do it with the firm money, but they're not going to allow you to do that. And then also go try to do that with another advisor. Ask your advisor that you're working with, do you have a strategy that can greatly reduce my taxable income? They'll tell you it's too risky. They'll tell you it's not good. Why? Because they didn't bring it to you. You call 100 advisors. I don't know if there's a single one that is going to give you the bank notes, that is going to give you the option, if you meet the criteria, of the energy fund strategy that we use. Go call 100, literally call 100, and you're going to get zero, is my belief, that bring you both of those strategies. A couple may give you the bank notes, right? I mean, still innovative and becoming more popular, but most advisors still don't do them. But if you want to do both, no way. It's just not happening. And that's what we're doing. That's what we are bringing to the table. So if you want to reduce your taxable income and have distributions, let's just call it double digits, because I don't know, if it's going to be 12, 13, 14, 15, or if it's going to be 20, 30, 40, right? I mean, it all depends on oil prices, right? But if you think energy is here to stay, and it's only going up and to the right, and demand is only increasing, which it is, and you want to reduce your taxable income, and you want to do a Roth conversion and minimize as much of that additional income as you can, then this is a great investment. At least it's something you should vet. It's something that we should have a conversation about. It's something that we should talk about. Business owners who's had a liquidity event, look at this strategy, invest in this strategy. People who sell property, obviously invest in this strategy. High wage earners. So if you're a doc or an attorney making, seven figures, multiple seven figures, obviously taxes are a concern of yours. Or even if you're making $500,000 a year, whatever. Or if you have $1 million net worth and you just want to convert from an IRA to a Roth and you want to do it as tax efficiently as possible, well, we should have a conversation. So when we look at diversification, that is how we look at the world. So 630-492-1912. Let's have a conversation if you have an interest. 630-492-1912. So 28, so we got 38, we got 43. Okay, I'm trying to, keep the segments of the radio show. My goal is to really give you a lot every segment. That's just what I want to do. I want to give you a lot of education every segment. So you look at the energy strategy, and it's so nice because when we craft portfolios, again, we'll go back to the beginning, right? Protected growth. Okay, so we've got the index annuity, the 5-year growth, we call it the growth index annuity, right? 5 years, tied to the S&P, you can't lose money. For that trade-off of not losing money, you're currently capped at 9%. Now that cap changes, of course, it does with the market, but currently it's at 9%. So if you're happy with no risk to the market, to your investment principal based upon, the insurance company, because it's their credit, obviously. It's not FDIC insured, but it's their credit. So if you want a guaranteed investment that you can't lose, and you're happy with the first 9% of the S&P 500, it could be a really phenomenal strategy. Now, again, it doesn't include dividends, it is what it is. I mean, so what, right? There's no perfect investment. But if you're happy with up to 9%, knowing you can't lose, then it's something you want to look at. And here's the nice thing about that strategy. A, it's short term, of course. But B, you're not having to play that catch-up game. And so we use it for our protected growth bucket, okay? Market's down 20. The next 25% of your gains are just going to get you to even to where you once were. Well, in this strategy, we don't need to worry about that. You're actually compounding your money every time there's a gain. That's really strong. The bank notes. Obviously, the bank notes. We talk about them a lot. Last one we did was Morgan Stanley, backed by Morgan Stanley, 12.3%. As long as the indexes it tracked weren't down 30, you made your monthly coupon of whatever it was, so 1.04. So there's a strategy. You're making money even if the markets are down to a point. So that's our protected growth bucket, right? Growth bucket, we're not going to talk a whole lot about that, even though the growth manager that we utilize, it has outperformed the S&P over 2% a year. That's a huge outperformance. Huge. They do rank in the top 4%. That's not them. That's Morningstar that states it. Now there's all kinds of disclaimers. You have to read it in what when we send you the information. But 2% outperformance on average, that's big. So if you put in $100,000 in the S&P 500 in 1995 and you fell asleep and didn't look at it until I think it was June of this year, the S&P took your $100,000 and grew to $2 million. Well, this strategy that we use the all cap and focus growth, is at $3 million. So those people that say you can't outperform the market, well, they just don't have the right investments. And so we got our protected growth, we got our growth plus, mathematical, trend following, et cetera, totally unique, very, very cutting edge. The manager we use, our minimums to invest are so low that every single person can invest, but if you go direct, you can't because the minimums are so high. It's averaged over 20% a year since 15. That's huge. Again, it's growth plus, so there's some volatility, but there's multiple years where it made 80%. So if you want to put 5%, 3%, 7% in that bucket, well, that's really good money, right? Potentially. And then we have the tax reduction strategy like I talked about. So when you look at the protected growth and the tax reduction strategy that has distributions in the tax reduction of, again, let's just call it double digits. I personally believe it'll be 15 to 20% a year, but let's just say double digits at $60 oil. All right, so we have to put that caveat in. Oil's higher, of course. Certainly could be more without a doubt, but again, we want to set expectations correctly the first time. We never want somebody coming back to us and saying, well, you didn't tell us that. So if you do 25, 30%, let's say 50% in the protected bucket, and then you do 10% in the alternative strategy if you meet the criteria, there's 60% of your money that is either going to deliver returns or protect independent of the market. Do you see why people are working with us? If that's what you want, let's have a conversation. 630-492-1912. 630-492-1912. I do owe you, in the last segment, we have to talk about interest rates, and we will do that right after the break. Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners. We're independent. We're a fiduciary. We do believe in financial planning. We do believe in income maximization. We do believe in tax reduction. We believe in all of that. Most importantly, however, we believe in incorporating strategies for the individual that has $100,000 to $50 million, whatever that number is. We do believe in incorporating strategies that can deliver returns independent of the stock and bond market. Strategies that can still deliver positive returns even if the market is down to a point. So if that's you, if that's something that you would like to learn more about, let's have a conversation. 630-492-1912, 630-492-1912. Our next dinners, by the way, are in Naperville, are I think October 2nd and 3rd at Morton's. So those dinners are very targeted. They're very targeted on tax reduction. So if you have $1 million net worth, not including your home, that would be a good dinner to attend. Again, we work with investors of all sizes, 50,000, 100,000, 10 million, 20 million, whatever. Doesn't matter. But this strategy in particular is $1 million net worth, not including your primary residence. If you want to come to that dinner, I don't know if we still have room, but certainly reach out to Paige and let her know those dinners interest you. And we'll certainly put you on a list for to have the first right to reserve a spot for future dinners. 630-492-1912, 630-492-1912. You can certainly call her and get on that list. So, okay, let's talk about interest rates. And what do I think is going to happen? How about this? I have no clue. And nobody has a clue. Not a single person that you talk with has an idea. Because we all can make assumptions, we all can make guesses, we can all look at the same data, and two people can have two totally different opinions. And you know what? They both can be right. We got out of the prediction game a long time ago, because here's what happens. Clients come to us because we're the experts. Of course, I get it. They want to know what's going to happen. I tell them I have no clue. Here's what I think will happen. But when you have an advisory firm that can be that transparent, that open, and again, we have an idea of what we believe. We have base case, and of course we do all of that. But we don't want to have to be beholden to our recommendations, because here's what happens. If I say this is going to happen, and it doesn't happen, well, guess what? I'm going to spend all my time trying to justify to clients why I was wrong. I don't care about that. I don't care about being right. I don't care about being I care about being wrong, but I want to be right more than I'm wrong. But we want to get out of that prediction game. Our job is to make money no matter what. Our job is to, even if we're wrong, that our clients are still making money, that we can point to a segment of their portfolio that can deliver positive returns in negative markets. And we can do that. In our protected growth bucket, as you know, we have the banknotes, we have the 5-year principal protection strategy, and then we have the energy strategy. So I don't know what's going to happen. I do know that things are slowing. I do know that, I remember, again, I was in the business in the late 90s, well, mid to late 90s is when I started. And I remember clients calling and saying, what are you doing wrong? You're only up 20%. And those are true stories. Those are true stories. And I also remember that what happened in 2000, 2001, and 2, where it didn't seem like the markets were ever going to come back. And I remember Fed Chair Alan Greenspan telling us that the subprime market and real estate can't bring down the market, can't do anything to the market in a negative way because it's such a small piece of the overall pie. Well, we know what happened there. The world almost ceased to exist when it comes to finances, literally. When banks, GEs of the world, and maybe it wasn't GE, but let's just say multinational, the cream of the crop, the best of the best, the core of the core, weren't having problems rolling over short-term commercial paper, you knew the world was almost coming to an end when it comes to finances. But they said, don't worry about it. They said it couldn't happen. Well, it did. And here we are today, and they're telling us not to worry about it. We're going to engineer a soft landing. I don't know what a soft landing is. I mean, if you can find an economic definition of a soft landing, that is, I'll send it over. I mean, I know what they tell us it is, but we're now to the stage of determining landings, hard landing, soft landing, whatever. I do know that we're at an all-time high, near an all-time high in the markets. I do know that they are now cutting rates, which is surprising. I do know that inflation is not what they say, because I do go to the grocery store. And hopefully you go to the grocery store too and you forget, take politics out of this equation. I don't care who you're voting for. And if you're really objective and you go to the grocery store or you're paying insurance, and I get they take out food and energy because they're highly volatile, blah, 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 right? Well, I mean, last time I checked, that's 30-40% of everybody's budgets, right? So I know inflation is high, and I know it's very, very high, and I do know that it's an issue. But now they're cutting rates, and they may cut rates even more. Well, what does that do to inflation? I don't know. I mean, I think math would tell you that it's probably going to go back. Well, I hate to say go back higher. I think it's going to increase even more. And I do know, I look at delinquencies, I do look at bankruptcies, I do look at defaults, I do look at everything that we're facing. I do look at the fact that the market is really driven by a handful of names. But you know what? All of that doesn't matter because the markets are still going up. And as I talk about with my son and partner, that, you know what? Markets don't care. Gains are gains. Doesn't matter how you get there. Doesn't matter if you should have them, if you shouldn't have them. And so we got out of the prediction game a long time ago. I'll give you as detailed and as thorough of an explanation of what I think that's based upon real data and statistics as anybody. But we don't know. That's why we build and construct the portfolios that we do, because we want to win. We want to really win when the markets are up, really, really win. But you know what? We want to also win when the markets are down. That we want to do as well, especially for our clients that are retired, and especially for our clients that are, need that income to live on. That's just what we want to do. That's what we're built to do. That's what our firm is built to do. That's why we're unique. Hopefully you recognize that. Hopefully you recognize the fact that the number one question, in my opinion, if you're working with an advisor, again, we're here to make you money. Do we want to be friends? Yes. Do we want to know the family? Yes. Do we want to have you be able to call us and ask us any question on anything? Absolutely. But again, the reason you work with an advisor is to make money, and to make money even if the markets are down. And that's what we're bringing to the table. That's what we're trying to do. And that's what we have. So that's what we're doing. 630-492-1912, 630-492-1912. Little family, personal loss that we experienced this week. It was very, very challenging, and it kind of humanizes everything. We did lose my grandmother. She was much more than a grandmother to me. It's more like a mom to me, just how my family dynamic was. Her and my grandfather were very influential in me, and I spent a lot of my life being raised by them, so I really considered them my parents as well. I have two great parents, but I was lucky enough to have two bonus parents, and so I do want to dedicate this show to her. Very, very challenging that we lost her unexpectedly. She lived a great life. The loss that I feel is significant, but hopefully I do know that we'll get to the point of just living the memories. So this show is definitely dedicated to her. So on a business note, if you have any interest and you would like to learn a little bit more about what we're doing, please reach out, 630-492-1912, 630-492-1912. So until next week, have a great week.